Alrighty, and I am regrettably late. I apologize, but we are here live with another episode of Negative 1G. Whoops, technical difficulties as well on my end. Anyways, that being said, here with another episode of Negative 2A 1G, talking about the Altman Z Score. Did a previous episode on liquidity and Altman Z is just, generally speaking, a way to view companies from the perspective of bankruptcy risk for industrial companies. That was the original purpose of the model, the the equation, if you will, of what Edwin Altman created. Dr. Altman of NYU Stern fame. Hello, McBuda T. And he created this with, let me get my cringeworthy Google spreadsheet or Google sheet up, the epic bruh moment. Uh, yes, right here, we have our formula. This, I, for presentation purposes, I've rendered the ratios here of it should be X subscript 1, X subscript 2, generally speaking, as far as standard mathematical conventions goes. But I figure for the purpose of relatively caring about presentation value, I've labeled the variables as such, and I've also laid out the ratios of such, and connected them to corresponding things here. So I have a noobish, basic, oversimplified, presentation model that we all get to work with, and I'll point out like silly things like this as far as what matters and how. So when it comes to the Altman Z score, this was gosh like 2019, I want to say. The model was 50 years old by then, so you would think that a lot has changed, and a lot certainly has. But the funny thing is, at least according to Dr. Altman himself, the weightings or the coefficients, and this is probably going to be insulting to McBuda T, but to other viewers, I don't know what level of math skills you're at. Coefficient or weighting is right here, like 1.2a. It just means whatever this variable is gets this much, whereas a 1.4, you're multiplying your variables before you sum them. If you recall order of operations, um, that obviously means variable B has a slightly higher weighting than variable A. Makes sense conceptually, whereas variable D not as much. So we'll also talk about the subsequent components before we actually do Altman Z, and I will also be deliberately making mistakes, and I will highlight where I'm making mistakes, just so that way you, the viewer, can see get a peek behind the scenes of some details. And also, while I will highlight mistakes and deliberate misuse on my end, I also want to provide the perspective of the thought process behind it and where some mistakes are likely to show up. So that way, hopefully, either you can come up with your own novel solutions, or if you could provide value add in the comments for future viewers and others. So variable A, or X subscript 1. This ratio would be working capital, and if we call working capital current assets minus current liabilities, you get working capital. It can be negative. It's very, very common these days for younger, newer companies where they would like to be paid up front. Sometimes that could be in the case of like a subscription service model, even though subscription models have been around for quite some time. But it just is what it is. So you can expect to have a negative ratio for this. So there's our numerator for the first ratio. Our second ratio, total assets, should be pretty straightforward. I pulled this data from 10Ks. What you really would like to do is you would like to grab the most recent data. But for presentation purposes, I don't think anyone's going to be too angry with me. Um, Anyways, our second ratio, X subscript 2, or as I have it here, B, retained earnings divided by total assets, RE, retained earnings. Now, here's one where if you're more accounting inclined, or just curious, you'd be like, well, why the heck should we care about retained earnings? If you recall to the balance sheet episode that Andrew and I did in a live stream, retained earnings conceptually is a lot like a student's cumulative grade point average. Let me double check here for presentation purposes that everything is okay. And I believe so. Just double checking here though. Yes, yes. All right, still okay. Yes. So, cumulative grade point average. Uh, and if we care about the future, like we're talking about a company's bankruptcy or the likelihood of default going forward. Uh, so why would we care about the past? Especially since if you really know your accounting, things like other comprehensive income can goes directly to retained earnings. You can be a little squirrely. A company can be a little squirrely, and we can't trust those darn auditors or accountants because their job isn't to detect fraud. Because for now, at least, it isn't. Um, but not necessarily, at least from the public auditor opinion. But yeah, retained earnings. If we look at it from a conceptual perspective, though, even with the for all the warts that it has, if a company has positive retained earnings, that would mean that for one, it had to have had uh, profits in the past. And if you have existing profits in the past, if you have positive retained earnings, uh, generally speaking, that would mean that you've invested capital into yourself. The other beautiful thing about, or the wonderful thing about retained earnings is return of capital to shareholders, such as dividends. Um, from an accounting perspective, that gets deducted out of retained earnings. Yes, cash would also be given out because most conventional dividends paid in cash, but from a balance sheet perspective, retained earnings would actually take the hit. So there's at least a little bit of like an eye for some nuance here that helps give this ratio some merit and validity. Uh, Next ratio would be EBIT divided by total assets. EBIT, if we consider EBIT, that would just be an acronym for earnings before interest and tax, interest expense and tax expenses. Uh, and I will harp on this one momentarily, but for now, I just want to briefly say when you model things out, uh, to be technical, if we recall our statement episode, the the operating income would be just in between gross profit and net income. Net income would include things like uh, interest expense and taxes, whereas operating income, because it is just before that segment, you would think, oh, that's EBIT. Close, and in some cases, yes, but not necessarily. Therefore, like I'll point this out with our two company examples. Spoiler: alert, that will be Pfizer, the misuse case, and Illinois Tool Workshop Inc., uh, a proper manufacturing company. So something more relevant for the Altman Z score, and D. For the next ratio would be uh, market cap divided by total liabilities. And this one is an interesting thing because for us to have a market cap of a company, we would need shares to be publicly traded. And this one is a bit of a sticking point here because Dr. Altman himself made modifications to his own model for other use cases for other countries. And this would assume that market is the market in question, as far as any stock market goes, is relatively efficient, and it's nothing too squirrely is going on there. Um, And spoiler alert, in this case I just used aggregators. I used Memorial Day, so that would be May 27th as a reference point of 2024. Uh, for market cap, not perfect, no aggregators perfect, but what you would do for modeling purposes is try and get diluted shares outstanding and multiply it by share price, and you would get your market cap. This can, will, and should fluctuate, which is why periodicity matters because like there will be a natural disconnect because all these components are kind of different. Like sales and income statement would be over a period, over a quarter, or over a year, what have you. Whereas a market cap, it's right then and there. Like it's instantaneous. It's as it's happening. Um, so you could kind of like poke holes and be a little skeptical and grumpy with Altman Z Score. I will leave that up to you. I'm just here, to give express or mention a tool, a possible tool, and the final ratio being sales, or net revenue, total revenue, what have you, divided by total assets. And this one, it's funny because I've seen conflicting numbers when it comes to these ratios, minor, and this was the only minor one. Uh, Whereas the coefficient, generally speaking, is zero point 0.1, but I've also seen it expressed as 0.999. So we can make of that what we will. Um, anyways, yes, we have our ratios, we figure them out, and I happen to do so from a modeling perspective. You know, I have things, I reference them, pretty straightforward. Thankfully you can hopefully see the reference cells, and you have your subsequent components. You would multiply them by their coefficient or their weighting, and you would get your parts that you would need to sum up, and hopefully we've built up enough trust where you can see where I get the number. And yes, number is wrong because I'm using outdated info. So like, things change, it happens, but you know we have number. And where did I get this? How did I get this? So if we go to, not this one, but this one, Pfizer balance sheet. So for presentation purposes, I pulled this off, like I said again, uh, 10K off of SEC Edgar. This is not perfect. What I did, certainly not perfect, because yes, like retained earnings for the purposes of Altman Z, you would use a balance sheet one, um, not any sort of outdated ones from like a statement of shareholders equity. Uh, you would use this, the balance sheet. That being said, uh, things like this, like I said, operating income, not necessarily EBIT, because from the rules of finance, sometimes interest is the thing. Like interest income, rather than interest expense, shouldn't be should be tilted one way or the other as far as being in favor of the company, or maybe from a perspective of conservatism or ultra conservatism, unhelpful conservatism, it shouldn't be included. So this matters. And granted, like if we have our income from continuing operations being this in millions, so you know we have that one 1058. We can see, oh, it's a little different. Uh, yes, in this case, it's pretty much a rounding error. But what I did in this case was I used Pfizer's toll revenues, and then all of these costs, and double checking here. Yeah, this is great value add right here. Uh, yeah, I think there was some sort of deduction that I did. Let me double check though. Our EBIT references those cells. Yeah. Yeah, having netted these details out, I ended up I think it was because what I did was I had a slight adjustment with the other part, which, and I left this cell different, which is why there's that slight rounding error. That's what I did. Um, so, important to, keep in mind what you're working with. Otherwise, like any model, it's garbage in, garbage out. In which case, you get what all Dr. Altman calls a zeta or Z score. Uh, People that aren't Sam Altman tend to call it the Altman Z score, hence the name of the model. Um, and we get 5.2. And the heck does this mean? Well, before 2019, it seemed like, broadly speaking, uh, Dr. Altman and his team originally had ranges when it came to this number. If the Altman Z score was less than 1.8, then there was a quote unquote distress zone. So anything below 1.8, high probability of declaring bankruptcy or default, distress. Whereas if a company's Altman Z score was at 1.8, or right at or just under 3, it was in a gray zone. There was a quote unquote moderate chance of bankruptcy or going default. That being said, if a company had an Altman Z score of 3 or higher, I butchered this by the way. I apologize. As far as mathematical expressions goes, I'm better with Excel barely than Google Sheets. That being said, 3 or higher, safe zone, unlikely chance of bankruptcy. It's hard to go bankrupt, like conceptually, as far as these ratios goes. If you have things like actual sales, if you have things like retained earnings, positive EBIT, and so on and so forth. Um, and yeah, yeah. So, like, that being said, though, it is possible to still go bankrupt and be a profitable cash flow flowing company because, say some sort of uh, lawsuit just blindsides you. Thank you, Fuhat. So, uh, the I have the caveat here of maybe zero, and I did clearly mention before 2019 for sure. The only reason why I referenced 2019 is because that was when I was able to find some videos where Dr. Altman was talking about his model. Things have changed, and as much as I really don't like macro matters. Details definitely matter. Interest rates matter, and as an example, um, the credit ratings, the average credit ratings have changed substantially, especially for bigger name publicly traded companies. Um, in the past, the number of AAA rated companies from, like, the credit ratings or equivalents was rather high. Whereas, if interest rates, and they have been at the time of recording in the past, they were rather low by historical standards of low single digit percents. So the amount of AAA companies these days that are publicly traded in the U.S. market, there's like two, I want to say, at time of recording. That's just because, like, if interest rates are that low, you would be kind of irresponsible as a management team not to take on at least some leverage. So it's quite quite the norm to see big name proper companies with credit rating scores of that triple B range ish, give or take. And yeah, we all have our gripes and complaints about the ratings agencies, how their customer pays for the rating, and they're a little, historically speaking, too slow to change ratings sometimes. They can be a little too too improper as far as like not lowering ratings severely enough or accurately enough. But that being said, though, like over time, and we at the time of recording, interest rates have been low for quite some time. So this one's not an issue. Like I think it's reasonable, the credit ratings that the ratings agencies have assigned from a broad perspective. uh, that being said, this would skew the Altman Z score quite a bit, and yeah, Dr. Altman himself said, based off of the older model, maybe a zero is warranted for the distress zone. That being said, I haven't been able to find anything as far as what the new updated gray zone would be, uh, because it would imply that if the 1.8 is now a zero, for that cutoff, for that upper bound threshold of a distress zone, then wouldn't it stand to reason that the gray zone also kind of shifts a little bit along with it, given the realities of things? Uh, maybe, maybe not. That being said, uh, this is for manufacturing companies. I used Pfizer as a frame of reference. Pfizer is not a true industrial company, so like the numbers can get a little screwy here. But a true and proper manufacturing company would be Illinois Tool Works, not Workshop. Illinois Tool Works. Um, I barely know about this company, but I'm aware of its existence, and that it is a actual manufacturer of construction and specialty goods, different equipments and so on and so forth. So this one is a perfect candidate for the Altman Z score. Much the same way I pulled this data, but this time for EBIT, what I did was I went the other way of taking net income and subtracting out things like taxes and interest expense. Uh, there's multiple ways to get EBIT, and yes, you probably could by and large get away with op, operating income, depending on the company, but again, details matter. And you know, if we have operating income here of let me bigify this. That is the technical term. Dur, 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 ooh, that is not cool. Um, yeah, we'll go with that 40/40. That is not 40/40. Differences abound. Like how you calculate EBIT matters, no duh. Uh, and at least based off of Dr. Altman's own presentation, he had one in the World, it was some sort of like founder or thinking foundation or something like that. He had a presentation, a video that's up there on YouTube, where he also expressed his equation in percentage terms, and I screwed up because having done it this way, maybe this should just be a one. Maybe if it changes to just one, that helps. Nope, not at all, not by any means. Um, but this number is supposed to be able to be presentable in both decimal form and percentage form. Adjustments would be needed to be made if you think in terms of percentages. Some people do, some people don't. Me personally, I think that this is perfectly fine, perfectly good, and I use it this way. That being said, your models, your rules, and be aware of how you do things, and you can get screwy details or results like this not good, this this is a screw up. So good to know. Again, same ratios, same format, and we have a number that even by older standards, from an Altman Z perspective, Illinois Toll Works should be viewed as, in theory, safe even by the old standard. using outdated info at the time. And again, periodicity matters because I used same date to generate this. Um, Now, why would some of us care though? I the funny thing is, and we can take this for what it is. Dr. Altman, when he talked about this, apparently the Bloomberg service, the Bloomberg terminal, is able to have a good look at what types of users are using specific ratios, and what their backgrounds are and what they care about. uh, Dr. Allman specifically thought that, oh, from a credit perspective, from a ratings perspective, if you're a banker, you would lean heavily on the Altman Z score. Reasonable, makes sense. That being said, though, not the case here. It turns out that, at least based off of the Bloomberg terminal, and maybe from a statistical analysis perspective, it's skewed because maybe there were more equity users than bond users. With the Bloomberg terminal at the time that they noted. He didn't exactly share a whole bunch of like p values in the presentation on that. Uh, but that being said, though, like apparently it was heavily skewed where it was actually like equity investors that use the Altman Z score far more than any other type. So we can make of that what we will. Maybe you can use this as a method of screening, depending on your style and preference of things, because default risk is a legitimate risk and a legitimate concern, and maybe some things just aren't worth a headache. Screening is perfectly legitimate, and there's a certain value add to efficiency for your time. So that being said, I just wanted to say that yeah, this was a fascinating thing to work with, just because uh, based off of his own videos, it really seems like the coefficients uh, are by and large unchanged over the years. Yes, some tweaks are made and some adjustments are made, particularly almost certainly with this one is my guess. Uh, but when it comes to adapting things for international companies, but uh, by and large, again, the man hasn't needed to update his own things, his own work. Um, Perhaps what he has advocated for is maybe using this with credit rating scores, and maybe you get more value add from that perspective. Hard to say. Not to be political, but it seems like Dr. Altman has made a case for using this with, or modification or version of this model with some sort of ESG rating, when it comes to looking at even private companies, small companies. At the same time, though, I would suspect that his definition of ESG is not necessarily the same as other people's definitions, because words and how we use them, friggin' matter a whole lot. Like ESG at the time of recording, pretty divisive and contentious word. And as I showed, with EBIT, the multiple ways to do it. Like there's at least two ways to do it. Maybe three if you're really lazy and just use operating income as a proxy. But yeah, again, nuance matters, details matters. So I haven't really been able to see the nitty gritty details on that work. He definitely does have academic papers out there. I encourage you to read those along with, because the funny thing would be that he wrote an academic paper somewhere around the 2000s, referencing his older work. And the hilarious thing is that because the Altman Z score is, again, as of 2019, 50 years old, so above 50 years old, no duh, um, modifications were made, even with an updated academic paper, where things like leases, the capitalization of leases and the treatment of that and how it's reported, very different because you capitalize a lease, and the way how it's mentioned in balance sheet is a separate line item, and not the same as it once was under older gap years, where it would just be treated as debt. um, there's one example. Another one also was he made adjustments, and if I recall correctly on the academic paper, and I will try to throw down a comment after this live stream is done. He did an academic paper that, and like that academic paper, he also referenced how when it came to total assets, he completely took away goodwill. Like that is a huge deal, especially with some companies these days, where goodwill is such an important and critical part of the balance sheet. Like, what if things change going forward? For example, IFRS goodwill is uh, is amortized over time. Not so with US GAAP. Maybe, and I have no idea because I'm not anyone important in the realm of accounting. I'm still just a student. But what if goodwill were to be amortized on U.S. GAAP adopted that? That would change things significantly. And again, periodicity really matters. So much so that I had it in caps and deliberately made a little funny thing here. Um, so again, how you model, you would generally want to model with conservatism in mind. Uh, but maybe a case for neutrality is legitimate. And again, context and so on and so forth matters. So that being said, wanted to say thank you all for tuning in, for swinging by. I appreciate you for sharing and putting in your time. It means a lot to me. uh Warner Brothers got Smash Bros again. That's funny. Hello Moxie, thank you for swinging by. um the little bit of value add that I wanted to leave off with is da, 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 da. The next two accountants one gap video would be the uh, at least for now it's penciled in that Andrew and I would be looking at the accounting treatment of joint venture, joint venture accounting. And also maybe as a bonus, we'll try and put in TIFs, some sort of tax advantage structures out there that companies report on, or report with. Uh, Someone was nice enough behind the scenes to mention a company, and digging has been done. That being said, I would anticipate that Andrew would likely be the one doing a lot of the heavy lifting because he's certified and professional. I am just a student. So that being said, though, there's that little thing. I want to say from a negative 2A1G perspective, the little subset, the little solo content that I do here. Someone proposed, "Hey, why don't you do some interviews?" And I think I will try and do that. And I will be reaching out to people momentarily. Please do leave comments as far as like how you'd like to see them structured. I personally am of the belief that from a value add perspective, I would rather people not necessarily talk about their book, more so their thought process and how they operate, what sort of things stick out to them, what things they disagree with other people. Uh, maybe you can disagree with that. Maybe you would like to hear pitches, which again I'm not necessarily opposed to. I would just would during pre-call work or pre interview work, um, I would like to have I would like pitches to not necessarily be degenerate. Like what I mean. Like if it's like some illiquid penny stock like that, like and you could be an ethical person and still do that type of work. I just would rather not necessarily do that sort of thing. Um, but I think the market is wonderful and full of different people that have many different perspectives, and Accounting is a powerful tool. Finance is a powerful tool, but it's not the only thing. Last live stream that I did, negative 2A1G one, was on specialty situations, specifically being merger risk arbitrage. I would suspect that being a lawyer really, really matters. If you are really good on your statistics, that certainly would help out a huge amount, especially from payoff and risk reward, that type of mindset. So, again, market's big, plenty of ways that people, do things and operate. And, hopefully that would be some great value add. And yeah, yeah. Also, from a audience perspective, do not expect me to be a gotcha interview. I'm not going to blindside people if I can help it. Like, don't get me wrong. If it's an interview, it probably will be a live stream, and I probably will try to incorporate some sort of audience interaction. But the guest is not obligated to show their face necessarily, or to answer questions if they're uncomfortable with it. I'll try and keep that in mind during the pre-work. Again, this is not a problem. So yes, thank you all again very much, and I will see you all on the next one.